Transfer Pricing Certainty, hosted by the Global Transfer Pricing Network. My name is Anand Vemuganti, a business advisor in tax lead at GTPN. I'll be moderating today's session. We are delighted to have such a strong turnout, and we are confident that the next 60 minutes will be both substantial, rich, and practically relevant for your work. For those joining us for the first time, GTPN is a specialized transfer pricing international tax advisory firm founded by the Big Four alumni with 25 years of leadership experience. We operate across 50 plus countries through 5 offices and 80 plus professionals, along with our 10 plus network partner firms. Our advisory spans full transfer pricing lifecycle from structuring, policy design through to compliance, audit defense, and dispute resolution. To set the stage, the budget 2026 marks a pivotal shift in introducing a revamped Safe Harbour framework designed to restore predictability, reduce audit exposure, and provide a credible certain pathway to multinationals. We are at the juncture where multinational Safe Harbor is now, we feel that lucrative for multinationals. We would see a traction because of the new thresholds, the margins, and the coverage. With this context, this session today will cover India transfer pricing dispute landscape, why this reform of the Safe Harbor regime becomes necessary, key changes introduced in the revised Safe Harbor rules, including the consolidation of the IT services, revised margins, expanded eligibility thresholds, and new eligible transactions. Next, procedural framework, which will be dealing with whether to opting into Safe Harbor, introduction of the new Form 49, what are the 49 applicable timelines and review mechanisms, and then comparison of Safe Harbor with other certainty mechanisms such as APAs, MAP, and domestic litigation, and finally, practical consideration for taxpayers, including when Safe Harbor may be appropriate and key compliance checkpoints. And it's my privilege today to introduce the distinguished panel, our keynote speaker, Mr. P Singh, a mentor and senior advisor to the Global Transfer Pricing Network. Mr. Singh is a distinguished expert in international tax and transfer pricing with nearly 4 decades of experience across government service, consulting, and academia. As a former Indian Revenue Service officer, he served as a Director of Income Tax for International Taxation and Commission of Income Tax Appeals, was a core member of India's competent authority team negotiating tax treaties with over 30 countries, and contributed directly to the drafting of India's first foundational transfer pricing regulations. Following his government career, he served as a senior director at one of the Big Four firms, and continues to shape the profession as a senior advisor to ICS Committee on International Taxation and a faculty at the National Academy of Direct Taxes. Mr. Singh brings in a perspective on today's subject that is both foundational and uniquely authoritative. Moving on to our other speakers, our first speaker is Mr. Praneeth Narahari, Global Transfer Pricing and Structuring Advisory Leader at GTPN, with over 12 years of specialized experience in TP structuring, documentation, dispute resolution, and cross-border tax advisory across 30 countries. He's a fellow chartered accountant, cost and management accountant, chartered financial analyst, and serves as a special invitee to ICS Committee on International Taxation. And our second speaker is distinguished Mr. C.A. Rishabh Agarwal, Corporate Structuring Advisory Leader at GTPN. Rishabh is a chartered accountant, All India ranked 50 in the CA final exams, and holds an LLM in international taxation from the Vienna University of Economics and Business. He is a recipient of the ICA International Research Award 2023 and serves as a special invitee member of CITAX ICA for 25 and 26. His practical spans international tax structuring, BEPS advisory, transfer pricing risk management, and cross-border dispute resolution across 30 plus jurisdictions. Finally, myself, I bring in close to 15 years of experience advising multinationals across Europe, Africa, and the Middle East on the transfer pricing strategy, value chain structuring, and tax technology implementation. By education background, I'm a tax lawyer. Just a few housekeeping rules in terms of the webinar time is scheduled for an hour. Questions may be submitted at any time via the chat or Q&A panel. We'll be address them during the dedicated Q&A segment at the end of the session. We would like to thank you, the Voice of CA, for the technical support for this session. Finally, without any further ado, I'm pleased to invite Mr. Singh to deliver his keynote address, especially being with the helm of the affairs of the government and now in the practice. Floor is yours, sir.
Thank you, Anand, for a nice introduction. It is my pleasure uh, to discuss about a very important development in India's transfer pricing regime, which is the revamping of the Safe Harbour rules. As we all know, transfer pricing regulations were introduced in 2001, and for initial few years, the adjustments were quite moderate, but thereafter it started going up and up and up. So, in the last 2 decades, the transfer pricing has given rise to intensive scrutiny, high pitch adjustments, and extraordinary volume of litigation. Transfer pricing in many ways has become synonymous with uncertainty for taxpayers as well as tax administration. Let us first talk about the consequences for the business. For business, the impact was not only about the tax numbers; they were huge, no doubt, but the prolonged dispute created operational uncertainty, delayed investment and location decisions, and sometimes affected the perception of India as a predictable tax jurisdiction. For tax administration, a very large amount of capacity was absorbed in repeated cycles of assessment, appeal, and judicial defense, often on similar issues. In many cases, initial high adjustments were substantially moderated or even reversed at the appellate stage. In other words, the system as a whole was spending a lot of energy without necessarily producing commensurate profits. For tax administration, it was not giving the desired revenue, and for the business, it was creating a long-term uncertainty. It was in this backdrop that the safe harbor concept was introduced in India. In fact, friends, the concept of safe harbor as well as APM came quite late. And this was mainly to enable the business as well as the tax administration to get hold of the concepts, become expert in these areas, and then deal with these, the advanced levels of transfer pricing. The policy which was introduced in 2009, the concept was very clear. The aim was to reduce dispute, improve predictability, and make India a more investment-friendly tax jurisdiction. Safe harbor was never meant to replace the arm's length principle. And I would underline this, that the safe harbor is not a substitute of transfer pricing principle. It was conceived as a practical, rule-based presumption within that framework. And if I summarize, it is something like saying that if you are within this margin, for this type of low-risk transactions, we will accept it without a fight. And as friends, we all know that the arm's length principle is based upon certain standard approach. It requires detailed functional and risk analysis, careful selection of comparables, and economic adjustments that is appropriate for complex transactions involving intangibles, unique risk, or integrated global value chains. But for relatively routine transactions, especially captive service providers, on a straightforward cost-plus model, the marginal benefit of granular analysis or investigation is very limited. Rather, it gives rise to higher burden of compliance cost as well as higher burden of administering the regulations. And therefore, safe harbor rests on the simple but powerful idea. For certain categories of low risk, relatively homogeneous transactions, a rule-based margin can serve as a reasonable proxy for the arm's length outcome, while drastically reducing the compliance cost and litigation. So that's, at the end of the day, is the basic concept which lies behind the safe harbor rules. Now, let us see how it is panned up. Many of you know or may be aware that in the initial years, safe harbor rules was not something which people were accepting. Why? The margins which were prescribed was very high, 18 to 20% for IT and IT-enabled services. This margin was much higher than what was anybody getting in tribunal and high court decisions. In fact, over time, jurisprudence moved towards excluding super profit companies, companies with significant intangibles, or very different risk profile when the benchmarking of the captive service providers were carried out. Now, what was the result? The result was a paradoxical situation. The safe harbor was meant to deal with the simplest and most predictable transactions. Rather, it came out with an option which was economically unattractive. Taxpayers realized that if they had to go through the regular transfer pricing route and if necessary litigation, then what they were getting was much lower margin than what was being proposed under the safe harbor rules. And that resulted in rejection by the taxpayers for adopting the safe harbor rules. Realizing this, the advanced pricing agreement scheme was introduced by government, and it has been hugely successful. Hundreds of APAs have been concluded, and they have given taxpayers a high degree of certainty, including for past years, whosoever have adopted the rollback provisions. But friends, APA is not meant for these type of transactions. It is meant for internationally, in fact, APAs are seen as an instrument to deal with complex, high risk, high volume transactions, such as unique valuation of unique intangibles, profit attribution to permanent establishment, complex financial arrangements, etc., etc. On the other hand, in India, a large number of APAs relatively dealt with routine captive service providers. So, in effect, we were using resource intensive, negotiated instrument for transactions which by their own nature were not at all complex. That did not mean that the APA program was a failure. Rather, it showed that the demand for certainty was very strong. It also indicated that the safe harbor framework which has been given is not something which is good, that needs to be recalibrated. And now this brings us to the recalibration. Yes, Anand?
No, thank you, sir, for setting the stage, and also I think you have clearly highlighted why the 2026 reform was necessary. So maybe I would like now to put some insights into what is this India's revamped safe harbor rules, and then what are these key reform and implications. Again, if you can put your policy hat and then give us a bit of insights on that as well. Thank you.
Thank you, Anand. In fact, what I will be doing, I will give, as Anand, you rightly said, a very high-level policy-based, view to the whole proposal which has been given by the government, which will be taken up on a very granular level by Rishabh and Praneeth, who will deal with the finer points, which will be of great interest to the audience. Now, when I look at what are the things this revised or the revamped safe harbor regulation is bringing up, the first and the most important is very interesting. It is clubbing several types of services under one banner, which is the information technology services. In fact, earlier, if you look at the rules, we find that there were fine distinction between different type of services like software development services, IT-enabled services, knowledge process outsourcing services, and certain forms of contract R&D. And if you look at the real life scenario, that the global capability centers don't always fit very strictly into any one of them. In fact, these centers do more than one activity. They handle application support, testing, analytics, and many other operations. Moving to a unified category is more realistic reflection of the business needs. The second, very interesting, is the margin which has been proposed, which is 15.5%. And this is very close to the margin which is coming out in the litigation process as well as in the APA. So, in that sense, it restores economic credibility to the safe harbor rules. And it becomes an option, in fact, for the taxpayer to seriously consider adopting safe harbor rules. The third is that the threshold for the transaction has been increased from 300 crore to 2000 crore. Now, do not go only by the number, it's very minor thing. The most important thing is what this is conveying. Now, it is conveying that even relatively large captive service operators can be covered by a rule based mechanism as long as they are genuinely low risk or the limited risk service providers. And fourth is very interesting is move towards the automated approval and multi-year certainty. If safe harbor is supposed to be the least complex intensive route, then a streamlined system-based process and reasonable period stability is something which anybody will like to have. And fifth is the extension of the safe harbor rules to certain type of the activities like data center and bonded warehousing. Providing predictable transfer pricing treatment for such sectors can complement, in fact, broader policy initiatives around Make in India, logistic efficiency, and data-driven services. Friends, taken together, these changes are more than incremental tweaks. They reflect an attempt to restore a proper balance between the tools which we have. And what are the tools which we have? We have the regular audit, safe harbor, and the APA. These are the three alternatives. Ideally, routine low-risk captive service transactions should gravitate towards well-designed safe harbor reason. Truly complex, high-value, high-risk transactions should be addressed through APAs. And regular audit and litigation can then focus on the areas where there is genuine controversy or aggressive tax planning. If this rebalancing is achieved in practice, it will benefit both taxpayers as well as the tax administration. The administration will be able to focus its resources on high risk areas rather than being tied up in thousands of similar cases involving standard margin. Now, there are two aspects which I will like to highlight. First is that internationally, the world is moving towards a simplification of low risk transactions. In fact, the OECD has come out with a guideline which simplifies approach for the low value added services. Further, the ongoing Amount B Project 6 standardized return for baseline distribution activities, and several jurisdictions have introduced one or the other form of safe harbor either for the technical issues or for the administrative implementation. However, there is one small challenge, and the challenge is the likelihood of double taxation. If the safe harbor proposed by India is not something which is accepted by the other country, then that may result in double taxation. What I feel is that over time it would be worth exploring whether some form of bilateral coordination or mutual understanding on simplified approach is possible with the key treaty partner countries. Now let me end with a broader reflection. The significance of these reforms goes beyond margins, thresholds, and categories. They also signal the maturing of India's tax governance policy. In the earlier years, strong enforcement was probably necessary to establish discipline and build a body of jurisprudence. As the regime matures, Stability, predictability, and proportionality become equally important. A moderate tax system has to differentiate clearly between high risk and the low risk areas and use different tools for the different types of problems. In that sense, safe harbor is not a concession. It is a way of using administrative resources wisely and giving taxpayers a credible, low friction route where the complexity is inherently limited. Finally, if the revamped regime is implemented with clarity, discipline, and mutual trust, both by the tax administration as well by the taxpayers, it can become an important pillar of India's transfer pricing framework and help shift the conversation away from the recurring disputes over routine margins towards the truly strategic issues that lie ahead in international taxation. Over to you, Anand.
Thank you, sir. I mean, that was very interesting how the perspective they put across, not only from a domestic but also international perspective, in terms of your always your experienced hat. What I will do next is further before we dwell into specifics of the safe harbor rules, revamped safe harbor rules. I would like first Praneeth to take up and then give a bit of a big picture, which audience wants to understand what is the current TP framework that we have in terms of dispute resolution. Praneeth, over to you.
Thanks, Anand. Good morning, everyone, for joining in today. Thank you, SP sir, for setting the overall context and sharing your policy perspective as well as practical insights across the transpricing landscapes from the inception to till date and what's ahead. I think that has made the slide simpler for me to explain. The context is to give a big picture. While Safe Harbor is a key reform, which is very lucrative and build on traction in the coming years, I just want to emphasize on one aspect that it's not the only option which is there on the table. Taxpayers would rather have to use a pragmatic approach by doing a comparative analysis between Safe Harbor, APA, MAP, and domestic litigation. So, with this context, I'll try to give a comparative analysis based on the key parameters, which is the coverage, timing, cost, and overall efforts involved to achieve certainty or resolution. So, on the first leg, we have preventive mechanism tools, which is Safe Harbor and APA. Safe Harbor is a rule-based mechanism where you have a set of eligible transactions listed in the rules and prescribed margins along with thresholds. So only you fall under the covered basket, you can offer this route. Whereas APA is more open-ended. Typically, it involves overall negotiation between the taxpayer and the tax administration. The focus is to cover complex transactions, but still you can also cover simple transactions, especially if those are high volume and those fall outside the purview of the Safe Harbor framework. And then you have domestic litigation and MAP. MAP is kind of alternative to the domestic litigation, which involves a negotiation between the competent authorities of countries involving transpricing and international tax cases, especially where it results in a double taxation. And you have the standard domestic litigation route, okay, which is more of a judicial process with a structured hierarchy of forums, right from the TPO AO level. The moment your case is being picked based on the cash-based tax risk parameters, you start with TPO AO, and then you have appellate forums or a fast-track dispute resolution forum, DRP or CIT, and then the final fact-finding authority, which is ITAT, and then especially for those cases which involve question of law, you can appeal further up to High Court and Supreme Court. That's on the domestic litigation. The timing is a key aspect. As I mentioned, Safe Harbor and AP are preventive tools wherein the taxpayers have to adopt a proactive approach before the start of the transaction. So for Safe Harbor, you file the application at the time of complaints so that you buy that insurance policy for that specific year. Now we have option of 5 years certainty for IT services, which is aligned to the APA years, which is 5 years option that you have in APA for forward period. Interesting thing is APA also has an option of rollback. So it's more of a proactive tool or mechanism. Now on the domestic litigation, as I said, it's not an option to the taxpayer. If you are non-compliant, or if there are TP risk parameters triggered, because now it's all risk-based assessment procedures, then you'll have to face the heat of domestic litigation. Through the process, if you feel that invoking MAP proceedings is an ideal option rather than getting a penalty at ITIT based on a treaty partner and treaty country, you can invoke MAP proceedings. Again, mostly in high stake cases because it has a lot of time and efforts and involvement of competent authorities. In terms of procedure, all Safe Harbor AP and MAP as a standard scheme of things, which is file an application, which is reviewed, and then there is a negotiation and then a conclusion. So this negotiation bit is what is missing in the Safe Harbor. That's what makes it fast track procedure. Okay. So overall time taken for Safe Harbor is 2 to 4 months, which is the fastest mode of dispute prevention tool. While API typically takes 2 to 4 years, while the objective is to cut down the number of months to conclude an API, especially in unilateral cases. However, bilateral may take 2 to 4 years. MAP, it takes an average of 30 months based on the OECD MAP stats for transferring cases. And the last is the domestic and TP litigation route. If you are going till high court level, somewhere around 8 to 12 years is what we see as a typical TP life cycle. Now, on the costs which are involved, Safe Harbor doesn't have any filing fee, and relatively it requires less time and efforts as well to file an application and get a conclusion based on the prescribed parameters. However, AP and MAP will require a lot more time and effort because it involves negotiation with the tax authorities or between the tax authorities. So not only the time, but also the resources have to be deployed, both from taxpayer as well as tax administrative side. And then the domestic litigation route, a lot of representation, submissions, hearings along the forums. So again, just to sum up on the slide, just going to the first line I'd made, Safe Harbor is really a lucrative option, but not the direct option. It's always pragmatic to do a comparative cost-benefit analysis, seeing the coverage, whether you're eligible for Safe Harbor or you're outside the purview. Then you look at APA, and then are you really required to look at Safe Harbor or APA? Because there could be cases where your benchmarks are yielding relatively lesser margins than what you see as prescribed margins for Safe Harbor, or what you see as negotiated margins in APA. Then it'll be relatively better to expose yourself to TP litigation route and get a clean order there. So those sort of comparative analysis based on the key parameters have to be evaluated, and right option has to be chosen. So with that context, I'll leave it back to you, Anand, where we'll emphasize more around the granular aspects of Safe Harbor. Yeah.
Thank you, Praneeth, for setting the stage and giving the overall framework and the big picture. I think now we would move on to understanding exactly the practical nuances as well as what is written in the revised Safe Harbor reforms. I would leave the floor to Mr. Rishabh Agarwal to take over.
Thanks, Anand, and thank you, SP sir and Praneeth, for setting the context. I'm taking a very small part on what has changed during the budget. So, to give you a context over here, that the changes that I'm going to talk about over here are related to what has been announced in the speech by the Honorable Finance Minister during the budget 2026 announcement. and what corresponding changes have come in the draft rules of the Income Tax Act 2025 that were released this year in 2026. Reason being, as we all know, that Safe Harbor, even in the 1961 Act, was only governed by one section, and which continues to be the same in the new Act of 2025, so Section 167, wherein the powers was given to create corresponding rules for safe harbor reform. So from definitions to what sectors to be covered, what would be the prescribed rates, conditions, eligible SSCs, eligible transactions. So all of this is part of the income tax rules. So the information that we are sharing here is part of the draft rules that has come out alongside the draft form or the application form for the safe harbor, which is now Form 49. So major changes that happened and which are triggering this conversation and this webinar as of now are majorly on the IT sector, wherein we saw that there were fragmented margins from 70 to 24% based on different category of services, IT or IT-enabled services, which now have all been clubbed into one single category of IT services at a 15.5% safe harbor margin of the operating cost. Similarly, another change in the IT sector as a push was to increase this threshold. So eligible people or eligible assessees, earlier the threshold was only 300 crores, which has now been increased to 2000 crores, so that now this benefit of safe harbor is not only available to small and medium IT-enabled service providers, but to even large service providers which are providing these routine, non-complex IT-enabled services, so that again even the bigger fish is covered to the the safe harbor side without going through the litigation process, uh, only for these routine low value not low value but routine transactions with limited risk. So that is there. Similarly, a multi-year approval process has been enumerated in the draft rules, where you can get a 5-year approval, uh, as mentioned by Praneeth, for the IT sector specifically. So that is also part of the change that has come in the draft rules. And this process has become automated. So you apply. I'll also discuss about the form and the application process in the ensuing slides. But you apply and there is an automated process. There is no human involvement for the check of eligibility and also for the check of to give you an approval of the same. Two major push that have happened around inclusion of new sectors in the safe harbor. One is on the provision of data center services. So we are seeing a corresponding exemption also under Schedule 4 of the Income Tax Act 2025. But yes, a safe harbor is there at 15%, which is 0.5% lower than the other IT-enabled services. So differentiation has been created between IT-enabled services and the data center services provision. And another safe harbor has been introduced as part of eligible business, so not just international transaction, but as part of an eligible business for non-residents, which are storing their components in a custom bonded warehouse for the manufacturing of certain electronic goods like mobile phone, laptops, and all of it. So they'll be allowed to have a profit margin of 2% on their operating revenue. So these are the major changes that came, which have triggered these discussions, push for the IT sector, new involvement of new sectors that have been introduced, and finally the form has been changed for which is Form 49, and we'll discuss in detail as well what are the parts and or interesting concepts in Form 49. Right, over
Th- thank you for the snapshot, Rishabh. I think before we go into the procedural aspects of it, I think Praneeth, maybe you can just quickly take about earlier versus revised in terms of the what key changes are there for our viewers.
Sure, Anand. So this slide gives a comparative analysis of what was there till now and what these reforms are bringing in. On the eligibility threshold for the ITS services, earlier it was 300 CR. Now they've increased it to 2000, which is a huge reform. One interesting stat to place here, CBDT chairman had made a mention that now with the increased threshold of 3000, there are literally only 100 IT firms which are left out. Rest and all of the back offices of the global MNEs fall within this threshold of 2,000 crores. And even within those left out of 100 entities, 60 already have APIs at hand. So only for 40 are the balancing figure. Even for that, they have rationalized the API timeline, saying that we will promise to close this entire API thing in 2 years, place additional 6 months, the taxpayer choice. So overall, the entire IT segment in India has become covered through this Safe Harbor or APA, thereby giving a clear tax certainty and stimulating the real economic development in India so far as IT sector is concerned. And the add-on on top of it is the margins. For ITS services, it was 17-18%. Before that, it was 20-22%. Now they've reduced it to 15.5%. This data point, again, on a comparative or relative basis, is very interesting because if you see the conclusions in the APA, especially on the unilateral APAs, still the rates are little higher than 15.5, somewhere between 16 to 18% or more than that in certain cases based on the FAR profile of the applicants. And if you see the domestic litigation trends, what we have observed in the last 7 to 9 years across all the jurisdictions in India is the lower percentile is starting somewhere around 20 to 22%, with the median hovering between 25 to 30%. So if you compare that to this is really good for the taxpayers. Now on the KPO and contract R&D, which got unified into IT services, the safe harbor rates earlier were not lucrative, which were between 18 to 24% for KPO and 24% for contract R&D based on certain parameters. Even on the litigation front, they were beyond 30% because these are seen as a high-end services basket. Now even that got clubbed into IT services basket, wherein they are giving a single data point, which is the 15.5%. It'll be interesting to see how this pans out in the litigation because they're clubbing all these baskets into unified segment of IT services. From a TP standpoint, the intensity of based on the FAR of these services might be different because ITS is moderate, whereas contract R&D and KPO is high end. So earlier, these definitions were leveraged by the TP officers while doing this categorization of these services to proceed with the benchmarking and the LP test. Now, will they leverage again on the unified IT services definition? My comment, not so, because it might not be favorable. They might still go with the traditional baskets of IT, ITS, KPO, R&D, MSS, BSS and based on that they will do the benchmarking analysis. In terms of sector coverage, all the set of transactions continue with the revised threshold criteria, the prescribed margins. Add on to that, we have two more additional eligible transactions, which is the data center services, wherein they have prescribed a cost plus 15% markup. This is again to lure MNEs to have their capability centers here, given that India is the largest consumer of AI, as well as lot of capabilities being set up in India to foster the AI market. And you also have this smaller addition, which is the component warehousing, which has a safe harbor of 2% on the revenues for the just-in-time electronic supply chain scenario. On the application process, there is a good reform, especially on the IT services, where they are making it electronic automated rule-based verification mechanism, thereby drastically reducing the bias or involvement of the officers in the verification process for the IT services. And again, validity. When the initial safe harbor regime was introduced a decade back, they said it will be for 5 years. But when the CBDT brought in notification, initially it was 3 years, and then later on they made it year on year. Even year on year, it was not practically viable because the Safe Harbor notifications of CBDT used to come in after the closure of year, just before the fag end of the complaints. So there was no time for preparation or documentation to be maintained by the taxpayer. Now they've made it beforehand that it'll be for 5 years for IT services. So overall, this is the comparative, and the bottom line is we are at a juncture where Safe Harbor is a real bet for multinationals, especially who are falling within the prescribed transaction categories and threshold criteria, to really offer it proactively at the time of complaints. While the entire scheme of things are applicable for financial year 26-27 onwards, I think they have to start adopting, revising the TP policy and agreements right from this year closure, which is 25-26, so that they have this consistency and continuity in their policy framework. It doesn't appear that you're doing it just for the sake of Safe Harbor. Yeah. And just one rider on top of it, you have to be very careful in revising the margins or markups, because if it is viewed as a trigger of business restructuring, because in a ideal scenario, you'll not reduce the margins unless there is a change in FAR profile, right? We have seen cases where the taxpayers have reduced their margins earlier because it was 2022, and then when it fell back to 17-18, most of the large entities, they have revised their the TP policies just to align with the Safe Harbor, but the facts and circumstances and the FAR matrix was the same. Okay, so tax authorities might allege that there is a trigger of business restructuring. That's where you have to tick all the boxes and ensure that your policy and Safe Harbor option is already defensible. Yeah, over to you, Anand.
No, thank you, Praneeth, for the comprehensive highlight in terms of. I think the message is really clear to the viewers. The revised framework is a viable dispute prevent option for routine transactions, as mentioned by Praneeth. I think quickly on the procedural aspects, on the paucity of time, Rishabh, please, if you can take over the Form 49 and discuss about the application as well as the review mechanism.
Right.
Over to you.
Thanks, Anand. So Form 49 is the application form. I'll only highlight the interesting things over here. It's now a common form for the eligible international transactions, eligible specified domestic transactions, and also the eligible business. So the component just-in-time warehousing, what we saw is an eligible business. So they've made a common form, again simplifying and keeping the same vision with the draft rules and also with the new Income Tax Act and the draft forms. So it has been divided into two aspects, even for eligible international transactions. So first, I'll talk about the other eligible transactions and then about the IT service transactions, because they have a special treatment in terms of application timelines. So the other international transactions, eligible international transactions, there are two conditions for the timeline. First is that you need to file the Safe Harbor form. So that's Form 49 before the return filing due date under Section 263 of the Income Tax Act 2025. And you need to file the income tax return either on or before the filing of Form 49. So what will happen? A, you need to make sure that you are filing the tax return before the due date, and B, that you are filing the tax return before the filing of the Form 49. So first the tax return and then the Form 49, right? Versus for IT transactions, since it's a 5-year continuous approval, a system-based e-approval, so you can file the Form 49 during the tax year for which you want to take. So this rule is applicable for tax year 26-27, starting tax year 26-27. So you can make application during the first tax year. So it will cover 26-27 and the next 4 years as well. So continuous 5-year approval. But the last date to make such application would be 30th June of 2027. So that's the following tax year. So we need to make sure based on the transaction. So if it's an IT service transaction, we have a more liberal timeline versus if we have other eligible transactions, we have a very strict timeline and also related to the filing of the return of income. So that is one. With respect to the information required, I would say that's pretty much standard in terms of, telling your taxpayer details, the years which you want to cover if you're talking about the IT service transactions, transaction specific details. So if you're talking about any of the specific transactions, there are different columns that you need to fulfill. So the party with which you are taking the transaction, what, the details of your profit level indicators, so your operating expenses, operating revenue, profit percentages, to show that, you are following the safe harbor margins, it is the safe harbor margins. What sort of transaction it is? So is it eligible international transaction, eligible specified domestic transaction, or eligible business? Basis that specific fields have been asked in terms of the transaction level details. With respect to being an eligible assessee, as everyone mentioned, in context setting, SP sir mentioned, later Praneeth mentioned, that Safe Harbor, the objective was to cover, transactions or parties bearing insignificant risks, and where you have low risk and, of course, routine services. So in order to decide the eligibility over here, there are certain checkpoints that have been given for the decision by the assessing officers and the transfer pricing officers. So the foreign AE should be performing the key functions. The Indian entity, for who is applying for the safe harbor, should not have significant risks. The Indian entity should not be owning intangibles, should not be having, major capital assets as well, and should be performing routine functions. So these are all technical TP terms. But at the end of the day, the bottom line is you need to do a FAR analysis over here and show that it is a low risk, low asset, and a low function entity in India who is applying for safe harbor, because these non-complex transactions were the aim of bringing the safe harbor into the transfer pricing regime in India, versus the APA, which has already been discussed for complex transactions. And can you go to the next slide, please?
Yeah.
Right. With respect to the procedural aspect, again, this is from the draft rules. You can see the rule numbers over there. As mentioned, for IT services, it's an automatic rule-based electronic approval. So we make an online application, again, only in Form 49, which goes to the DG systems. It will check the eligibility. If you're an eligible assessee and you have entered into an eligible international transaction, that's IT services, you will be given an automated approval for the years that you've mentioned in the form. It also has a deemed approval. So if there is no acceptance or rejection received within 2 months from your application, then it's a deemed approval for the IT services. So again, now you have a trail, which was earlier an issue. So now you have a trail that when you have filed the form, so complete audit trail is available in order to prove that you have a deemed approval for Safe Harbor. Of course, if there is a rejection, there will be a reason for rejection and you'll be applied. You will be allowed to give one communication on why such a rejection should not happen. Versus for other transactions, the application goes to the assessing officer. So your assessing officer will refer to the transfer pricing officer for assessment, that not a transfer pricing assessment, but an assessment that you are an eligible assessee and the transaction that you entered is an eligible international transaction. When these two things are satisfied by the TPO, communicate to the AO, and finally you will get your approval order of safe harbor from the assessing officer. The key aspect over here is that these safe harbors are not arm's length rates, these are prescribed rates, and the safe harbor regime is an application approval based regime. So you cannot just say that, okay, I am above 15.5%, so I am out of the crosshairs. No, it's an agreement or it's a relief given by the tax authorities to the taxpayer when you apply for the safe harbor in the prescribed form. That's Form 49 over here. Another important aspect over here is that this does not absolve you from filing your TPO audit. That's there, and that's Form 48 as per the new draft forms, and also to maintain a transfer pricing documentation. Because if you see the timeline, you need to file the return, and then you need to file Form 49 for Safe Harbor. So while filing the return, you already do your transfer pricing audit 1 month before the return filing due date. So that already needs to happen. That already needs to happen. To do a transfer pricing audit, you need to have a transfer pricing documentation in place. So this is only an administrative relief and certainty in terms of margin that you need to maintain once you get the approval from the tax authorities. It does not absolve you from any obligation of transfer pricing documentation. And I think this sums up Form 49, Anand.
No, thank you, Rishabh. That's quite insightful. I think the next slide kind of gives you the most important question from all the audience and everyone. When should taxpayers opt for safe harbor? Praneeth, over to you.
Thanks, Anand. I particularly like this slide. In any client presentation, I would definitely incorporate it because it kind of sums up all the key attributes that go into decision making while opting for safe harbor. So we are covering three aspects here. When you can opt for safe harbor, why you have to do, and in what scenarios the safe harbor might not be ideal and you have to look or fall back on APA route. When obviously you should be a covered entity based on the listed or prescribed transactions. You should be falling in one of the baskets, and on top of it, there are thresholds prescribed for each of the category. So as long as you're falling within those prescribed categories, then you can offer it. And most important aspect in the entire matrix is the FAR profile. Okay, that's where your TP documentation will come handy, where you can portray that you are a routine or low risk entity. Then you can offer safe harbor. All the entrepreneurial principal high risk bearing entities, even though if you are ticking the transaction criteria or the threshold criteria, still you are not eligible. If you still go ahead and file, there are enough records or documentation which are sought for during the verification process when they will reject your application. So that's an important criteria. Now, on why you have to do all this, recently I've had a lot of conversations on can I reduce my 17-18%, which is my historical TP policy, to 15.5% and maintain a TP documentation and file Form 49 or file Form 3CB and be protected from the TP audit exposure. My straight answer to this is again, safe harbor are only reference points, a prescribed margin. They are not ALP ranges. Okay. If you don't go and file an application and get an approval, you are still exposed to TP audit, which is your regular domestic litigation route, where the margins or conclusions are definitely higher because they are pro revenue and high pitched, as SP sir mentioned. So, and one more thing is, if both are same, the safe harbor kind of becomes redundant, right? So it's an approach that the revenue follows to push all the taxpayers to go for this dispute prevention mechanism. So you can avoid those TP audit exposures, which will have tangible cash tax outflows, penalties, and interest. On top of it, in addition to primary adjustments, there is also secondary adjustment exposure where you'll have to align your cash balances to the tax adjustments, uh, which is actually raising an invoice and bringing in those cash flows, which becomes difficult, especially after that particular financial year in closure. And the prolonged litigation is one at hand we have to face because most likely at a first level, which is TP or AVO, we see adjustments happening because they don't generally go by the facts of the particular taxpayer. They have large data sets for each of the sectors, which they apply across the taxpayers. So the real marginal relief comes at a CIT or DRP road, and more relief is expected at ITIT. But the entire process takes a lot of time and efforts, and also costs. You might also have to do some tax deposits. So to avoid all these sort of exposures, to have certainty on your tax positions and your overall budgets and cash flows, and focus purely on business, safe harbor is a must option as a recommendation from our side. But again, there are certain scenarios where safe harbor might not be ideal. Most of the points SP sir has already touched upon. The first is complex intercompany transactions because they are not covered under the prescribed listing. Second is the FAR profile. If you are not a routine captive risk insulated entity profile, which is entrepreneurial principle, so you are not fitting in that categorization. And then when you have multiple transactions, this is an interesting scenario where only few are eligible and you get an approval. The rest are still exposed to TP audit. So in these sort of scenarios, you have to do a cost benefit comparative analysis, whether your not covered transactions are yielding you higher exposure or your covered transactions. Your uncovered transactions are yielding higher exposure. Safe harbor is kind of redundant or at least as an insurance, but still on the other transactions, you should maintain robust documentation and face the litigation hit. And then there are high stake cases where can't look things from a unilateral or one-sided perspective. You'll also have to see the tax positions or outflows on the flip side jurisdiction, which is your AE jurisdiction. So in cases where you are looking for a bilateral resolution, okay, then you might have to look for bilateral APA. And the last aspect, which is the key aspect, again, this is a practical, logical aspect. Many of them say that the benchmarking results are still lower than this safe harbor rates prescribed for each of the transaction category. If you are confident and clear that that's a accurate reflection of industry trends, you can bank on the benchmarks and documentation maintained and expose yourself to the domestic litigation route and defend those documentation and benchmarks. So that's to sum up on this slide.
No, no, thank you, Praneeth. What I'll do now in paucity of time is, so what we have done a research and then, send questionnaires across our clients, and we have almost got 100 responses. Just to highlight, we have got all of them into 7 important questions. What we can do is, anyway, we would leave this in our YouTube channel as well as in LinkedIn as well. And then if anyone has any questions, or anyone wants more specifics, you can reach out to us. We can answer on one-on-one basis. What I'll do quickly is to go to the final slide, considering we have the last 3 to 4 minutes left, is about the best practices for managing TP risks in India. The best way to do this slide is go across the board, starting with Praneeth, Rishabh, and myself, and then finally, maybe the final comment from SP sir.
Yeah,
Praneeth.
yeah, happy to start the relay. So I'll just focus on the first 2 points. One is to ensure compliance. So all the dispute prevention and resolution routes come at the second phase. The first place we have to ensure that we are ticking all the boxes and ensuring compliance obligations are comprehensively and timely met, because non-compliance in itself will be viewed negatively by the tax authorities, be it your 3CB, TP study, local file, master file, maintaining the intercompany agreements, TP policy, and the entire backup to that in terms of overall audit trail. So ensure timely compliance. Second thing is the transaction level risk assessment, okay, which many of them miss out. So it's kind of a TP health check or a due diligence or a diagnostic review where you flag transactions based on the risk category from a audit lens, and see what you can defend before the litigation route and what you have to put it in the safe harbor basket, and which are the left out complex and high value transactions where APA might be ideal solution. So this TP diagnostic review is one of the important, so that you're clear on your tax positions and any provisioning that has to be done. Yeah, over to you, Rishabh.
Right. I've mentioned that before, and SP sir also mentioned where to use Safe Harbor versus APA versus MAP. I think we have to be very clear. Safe Harbor, routine transactions where your entity, Indian entity, is doing low risk services. APA, complex transactions where you need further more certainty. And MAP, where you have a treaty issue or where you need to do a bilateral negotiation beyond the TP issues as well. So that's where you go for an MAP. Second point over here, continue to maintain your transfer pricing documentation, align your group level documentation with the safe harbor or this unilateral relief that you've got in India. Make sure it becomes part of your group master file, local file, also your CBCR reporting, and it clearly shows in your TP policy that you are going for a safe harbor, so that it is aligned in terms of what you are doing at the ground level versus what everyone or the management sees at the policy level. And of course, you continue to monitor updates from an India perspective. We will have a major update when these draft forms and draft rules will finally be passed, by the tax authorities, and we'll have the final version. And of course, the new filing process starts for the tax year 26-27.
Thank you, Rishabh. I think I'll just close off saying again, understanding overall group level tax impact for opting safe harbor or other certainty mechanisms, which I think we have given clear insights over the time, and then the documentation again, and finally technology. So if there is an impact that you see multiple entities and having a certainty in terms of all the data at one point of one place, and also making sure looking at even from a risk management perspective, that is clearly important. I would leave the final thoughts to Mr. SP Singh. SP Singh, sir, please.
Thank you, Anand. If we look at, there are two aspects to the whole new regulation or the proposed regulation. One is the margin, and there one has to be very, very careful. I mean, it is not, something which you are otherwise, I mean, liable to higher margin and try to take advantage of 15.5%, because the functions and the FAR analysis remains there. That has to be carried on, as has been mentioned by all the speakers. And the trust is at the core of the whole system, because the government has come out with a very thought out and very positive oriented, I mean, scheme, where, I mean, the trust has to be shown both by taxpayer as well as tax administration for the whole scheme to be successful. And I will not try to repeat, I mean, what Rishabh and Praneeth have said about how to pick which route to be taken and when to be taken. Suffice is to say that be careful about the transfer pricing documentation, be truthful, put everything, I mean, all the facts, and then take a conscious decision about which route to be taken. And last but not the least, I would like to thank the three speakers, I mean, Anand, Rishabh, and Praneeth, for nicely summarizing, an area which would be very, very helpful for the taxpayers to avoid, I mean, protracted litigation, and to have a more beneficial regime where they can focus more on the business rather than deal with the transfer pricing and the taxation issues. Thanks. It's really a pleasure, I mean, attending this seminar.
Thank you, SP Singh, sir. Thank you, Praneeth, and thank you, Rishabh. I think just a final pointer here. Today's session is the first of the two-part series, and the second session will be API regime in emerging markets, which is led by Mr. Kuldeep Sharma. You can see he's also on the screen today with us. He's a globally recognized expert in international taxation and TP with over 30 years of leadership in both government, also in consulting, as well as in with global policy institutions. So this will be held on 9th April. So we look forward to that session as well. And thank you all for joining. We have noted down your questions. Sorry for the paucity of time if you are not able to answer. But again, we will share this on the LinkedIn as well as to the network, as well as in the YouTube, and then we'll answer any specific questions individually. Have a wonderful afternoon and take care. Thank you all for joining. Bye-bye.
Thank you. Bye.
Thank you.